Hello friends, today we will learn about a lot of different concepts in the derivative markets. Now, we have learned about what different types of derivatives, but we will understand how do we do a trading in the derivatives. Now, how do we trade in the derivatives? You must have a demat account and you go to the stock market and you can deal in the derivatives. Like for example, you can sell and buy bond derivatives, you can sell stock derivatives, you can sell the index derivatives, you can sell the currency derivatives, you can also sell the commodity derivatives. Now, how does the stock market works? Now, for these to understand, we need to understand what is a demat account. Okay, we need to understand how do we buy it and sell the derivatives. Okay, and while you're buying and selling the derivatives in the stock market, we will have a demat account, and this demat account normally is given by a broker. Now, who's a broker? A broker is a member of that particular stock exchange. Now, you open an account with the broker, and the broker you have to trade. Now, how do you trade? For example, let us understand you have to buy a gold after 3 months from now. Now, if you are buying a gold 3 months from now, you will buy the gold 3 months from now, and after 3 months, the buyer will pay the money and the seller will give the gold, right? Now, in order this to happen in the future date, you have to keep some money with the broker. Okay, the broker in turn will keep this money with the stock exchanges. Now, this we call it as margin money. Okay, now you understand, we have to keep some money as a margin money with the stockbroker, who in turn keeps this money with the stock exchange for the purpose of buying and selling a particular financial instrument, which is basically called a derivatives at a future date. Okay, now we understand what is a margin money. Okay, now since we are buying and selling a particular commodity or a stock or any other financial instrument at a future date, every day if there is a difference in the price between the actual buying and selling and the price today, that difference, okay, we call it as mark to market. For example, we bought a commodity for 50,000 rupees 3 months from now. Okay, now that particular commodity in today, if it has becomes 45,000, okay, 45,000, which means you are under a loss of 5,000 rupees if you consider today's price. Am I correct? So this particular commodity, mark to market, if you see, it is value is only 45,000, but whereas we have bought it for 50,000 rupees. Now we understand what is a mark to market. Now every day, every minute, this mark to market will be given by the stock exchange. Technically, what happens when you buy the future, we buy it at the today's price. At the future date, let us say we bought it for 50,000 rupees after 3 months. But actually after 3 months, if the actual price is 40,000, okay, so basically you will be losing 10,000. Okay, but we are least bothered about that 10,000 because we are deciding it today because we want to hedge that risk. Okay, it may go loss also. Okay, in this particular case, we went loss if it becomes 40,000. If it becomes 60,000, you will buy it at 50,000. So therefore, profit or loss on that particular commodity on that particular price, as well as our future price, if the difference, if you see, you can verify whether there is a loss or profit. Okay, but that is irrelevant for us because we are buying at the predetermined rate, and once predetermined rate is very clear for us, and we don't worry what will be the market price on that particular day. But for the purpose of understanding what is mark to market is on that particular day what is the market price. We call it as mark to market. Now we understand two concepts. One is margin money, one is mark to market. Okay, two things we have understood. Now at this point in time, we also need to understand there are three other concepts. Okay, whether you are buying and selling the stock, or whether you are buying and selling the real estate, whether you are buying and selling the commodity, or whether you are buying and selling the currency, anything, there will be technically three kind of people. Okay, one fellow is called arbitrager. Okay, another fellow is called a speculator, another fellow is called hedger. Okay, now these three people, what they do, okay, so they basically bet on the future market. Okay, a speculator, what he will do, he will bet on the whether the price will go up or the price will go down. For example, if he is buying, if today's price of that particular commodity is, let's say, 40,000. Now if he expects the price to go up, okay, let's say 60,000, he will buy it at 40,000 and he will sell it at 60,000 and will make a profit. We call it as a speculator. Now who's an hedger? An hedger is somebody who will hedge it, who will buy it for the purpose of hedging. For example, somebody is supposed to, okay, receive some money in foreign exchange from foreign country. Okay, now he has to receive 3 months from now, let's say $100. Okay, he's billed, when he billed $100 of invoice, $1 was 65 rupees. Now when he is receiving this money after 3 months, the dollar may go up or the dollar may come down. Okay, let's say the dollar goes up 70 rupees. Okay, so when he receives the dollar, when he sells the dollar, and if he sell it for 70 rupees, 100 into 70 will get 7,000 rupees. Okay, he makes a profit. What if it goes down? If it becomes 50, okay, then he'll receive only 5,000. So he doesn't want to take this risk. So then what he will do, he'll go to the future market. Today only he will sell it at what the price today, what he is billed in the market, because he will be receiving the dollar only after 3 months. Okay, now these kind of people we call it as hedgers. Now we understood hedger, we understood a speculator. Now who is a arbitrager? See, there is something called spot market, there will be something called future market. If there is a price difference between the spot market, okay, in simple terms, what is the valuation? Very simple. A spot market plus interest rate for that period will be equal to future price. If there is a difference between this spot plus interest rate, okay, is equal to future, if there is a difference, this difference he will buy it in the spot market, sell it in the future market. He will sell it in the spot market, he will buy it in the future market. This we call it as, without risk he will make profit. We call them as arbitragers. Now we have understood 5 concepts here. One is the margin money, then another one is the mark to market, another one is the speculator, another one is the arbitrager, another one is the hedgers. Okay, now by this we complete our session on understanding components of derivatives market.